that's the bounce we've been looking for. That's the kind of move that we were hoping to get on Wednesday when we got that nice opening gap that we ultimately filled in pretty quickly. We did not fill that gap in today, and we had a nice good rally into the close. This is what we want to see. So again, this doesn't mean the end of down days, but I do believe that this is the beginning of that second stage of that rally off of the pullback low point. Even if we get a new lower low on Monday or Tuesday of next week, I think the momentum, the bearish momentum is down. This is the kind of move that starts things to the upside. A runaway gap, good strong momentum, closing above Thursday's high point. Everything's looking really, really good and it's not the greatest like rotation that we had today. It's it's not necessarily like it looks like we're rotating right back into the things so we're going to break that down, the sector rotation. So again, remember the question is, we knew it was going to bounce, right? We knew that the 100% probability there'd be a green tag coming off of a red tag. So we knew that there was going to be a bounce. The question is, because of the depth of this pullback, is this bounce likely to fail to get to new highs? That's the question. And so, we'll talk about today, like the rotation that we've seen and whether or not the odds are looking good yet that this day one of this bounce will ultimately turn into new highs or not, and whether we'll fail or not. So we'll break all that down. And then our trade ideas is one way to take advantage of day one of the pullback bounce, and how can we trade that, and we'll give you an example of how you can be able to take advantage of that. So let's go ahead and get started. Today is Friday, March the 14th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. Alright, if you're watching on our blog, check out some of these other things over here on the right, including our Market Outlook live video. That's where I take a look at old Market Outlook trades, either whether we should stay in them or get out of them or not. We also put on the that current day's Market Outlook trade before the market closes, so you get it beforehand, before watching the actual Market Outlook video. Come down to the bottom, click this heart, it opens up this tab. Click that like button there. Same thing here, click this thumbs up icon, it opens up this tab. Usually opens up the current Market Outlook post, and you can click on the like button there. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now. We can keep reaching our goal. Our goal is to get over 50 likes. So thanks again. All right, let's take a look now at the market forecast on the S&P 500. And you can see a really, really good day today. First thing, unlike Wednesday we had the promise of a good day with a really strong gap on Wednesday, almost 2 standard deviations. We don't need it to be 2 standard deviations. We just need to be more than 1. Today was clearly more than 1. So we started off with a really good opening, and then the idea is that after the gap that we run away from the open and finish with a 2% or more gain, at least close to 2%. Well, we got over 2% by the end of the day today, and ended up with a really, really good short-term market forecast pattern. So we crossed 40 and 50. Now again, it's it's nice to cross multiple lines. It would be nice if we crossed 60 as well, but we didn't cross 60. But the momentum line jumped anyway. Like it jumped, it's well above the near-term line. It's well into the reversal zone. In fact, it's at extremely bullish levels. That is outstanding. That is a great, great chart. So it means that we are and we closed above the high of yesterday. Again, 2% gain. We ran away from the open. There's no lower shadow here. This is a great day, about as good of a day as we could get. So it kind of, now this is, if we're going back to the tweet that I share here, and let's put this over here really quick, and we'll just bring this over so you can see it. So this tweet that I have right here, so this is the tweet I just barely put out today. As you can see, the 9 stages of a bear market, this tweet right here. So here is a long thread. It's a very long thread that goes through every single stage, right? The first stage, the second stage. So we just had the first stage. First stage is a pullback of 5 to 10%. This stage right here, it's the very first stage. If this is the full bear market from green tag to first green tag to last red tag, that's the full bear market. Then we're at that stage right there, stage 1. So now today we are starting stage 2. So stage 2 is a bounce, right? We bounce back up, we get a green tag, and it starts, you can see, really bullish, right? We get to that 5% tag very, very quickly here. And so the question now is, of course, whether it fails or not, but this is definitely day 1 of the second stage. That's a clearly bullish pattern. Where the near-term line is most likely, we're back above the 5% mark after having been below it. The near-term line is going to make its way back up. I mean, we are clearly well below the moving average still. So we're not like strongly bullish here. But that's a strong pattern. Really, really good day for the S&P. The NASDAQ 100 looks very similar. We also crossed 40 and 50. The momentum line got up above 90. Again, very good day for the NASDAQ 100. Remember, your Dow Jones Industrial Average had 3 clusters. It didn't have as good of a day. I mean, this is about as bare minimum. Like the bare minimum for a good short-term pattern is the near-term line crossing 40 and the momentum line being above it. That's the bare minimum. So we got that, right? And again, you would like to cross multiple lines on the near-term line, not just 40. You would like to, for the momentum line, to get above 80, if not above 90. But that didn't happen here. But at least, again, we closed above yesterday's high, and we're still okay and had a pretty decent return. Then your Russell 2000 also crossed above 40 and 50. Near-term line strongly bullish, closing above yesterday's high. In a good move to the upside there. So everything looking really good. And as a result, it kind of had an impact on the weekly chart too. When you look at the weekly chart, we avoided having strong bearish short-term sentiment. We avoided closing below the 5% mark on a weekly basis. We did get a bull tag, but now we have a pretty good possibility that we'll bounce off this bull tag because we should have a good week next week. I would expect that we'll have a good week on the S&P 500. Again, expecting that we'll get this green tag. I think, I've told you before that, if this is stage 1 of getting this decline, we'll get a green tag quickly. Like I even told you, I've been telling you all week that most likely we'll get a green tag by expiration, which is next Friday. We're already halfway there. Almost halfway there. 2% gain. We got 2.13. Only need to get 5% on the closing basis, and we're there, right? So we're already halfway there of getting the green tag. I told you when it comes very rapidly. As you can see, we're already 2%. I also told you it would have a big range, and we had a big range today. We'll take a look at that in here a second. Let's take a look at this other weekly chart. We did cross the 40-week exponential. We are still falling on the PPO. It's a pretty decent sized candle, bigger than what we've had for a while since the last correction. The biggest bearish candle we've had since the last correction. Obviously, we've had 3 red arrows still. Like this hasn't changed, but you can see the MACDs are at least getting closer. The Russell 2000 is close to at least 1 green arrow. So we're getting closer to not having the pink shading anymore. And then, of course, if you look at the 2-line versions, as great of a move as we had, we're still below the 8-day moving average. So, that's how bearish we were, that it takes, more than a 2% gain to get you almost to the 8-day, not much less getting above it, right? So, we still have some work to do. We have to get above the 17-day before we really feel good about this ending. And you can see the 17-day, like right now, at 575, 75 is where it is currently. And if you were to divide that by where we're at currently, that would be another 2% gain, 2.3% gain Monday just to get to the 17 days. So, and then, by that time, you're almost at a 5% gain, probably 4.5% gain. So you see how much of a rally that this is why it goes so fast when we bounce off of these lows. Now we might get a down day Monday, and then we might get the 2% gain Tuesday. Just because we're in the stage of getting a green tag doesn't mean we're going to go up every day. It will happen rapidly, but it doesn't mean that we have to go up until we get there. There might be some ups and downs, right? As you can see on a lot of these other bounces off of lows that we get. If you take a look at the DMI pattern here, you'll see that, again, the ADX is really high, but now we're almost, we were so extreme on the positive indicator, almost back above 10. We're back below 30 on the negative indicator. The RSI and the CCI were both also extremely bearish levels. We're back above minus 100 here. We're back above 30. Still in bearish levels, but not as bearish as they have been. not as extreme. The Ichimoku cloud, we still have a mature trend, so the trend hasn't changed. We're still below the blue and the green lines, and the cloud's still pink. We're still well below the cloud. The rate of change is still very negative. So one day doesn't change any of that. It just halts that downward momentum. You're not going to go down every single day. You're not going to get a red tag that's most likely it's got like a 20% number in it. It gets to 10%. That's where we got to. The Bollinger Bandwidth got extremely high. We're back above the Keltner channel after being extremely low. The momentum is now down to almost 3,000 there, just to kind of give you an idea. Like, that's even worse momentum than any bearish move that we had during the 2022 correction. It's strongly bearish momentum. Not surprising that we'd have a bounce. We've been looking for it all week. By the end of the week, we were looking for it. We finally got it here. We were looking for it on Wednesday. It didn't, because we filled in the gap. As you can see here, we filled in the gap immediately on Wednesday right there. So we had that nice gap to the upside, but we filled it in. Here, we gapped up and then kept going up, retested it, and then we rallied up above the previous day's high, and we closed above it and got up to that 2% gain. So still below last week's low, but you can see like last week's high point's right here. So we're actually closer we're closer to this week's high point than we are this week's low. So, makes it likely that we can, again, have a bullish week next week. I think we'll end up having a bullish week in the markets. I also told you that, the first couple of up days would be pretty big ranges. We were above average in the range. You can see the average continued higher, the ATR, continued higher. We also had pretty decent volume above average. So, it's less than what we've had, but it's still above average. But the range, the next, Monday or Tuesday, depending upon whether we go up on Monday, but even if we have a down day Monday, but then we rally big on Tuesday, like that day is going to be a big range too. So this normalized ATR usually doesn't start to falter until we've established the low point. You can see it peaked a few days after once we started but these first few days have really big ranges. Like that was 13, 12 almost, 13 and a half, under 10. And then we dropped down to 5 and 6 and 4 and 6 and 5. So that's kind of the idea. The average range right now is 10 points. So we're going to have double-digit ranges here for the next couple of days, few days, as we get to that green tag. And you remember the green tag will basically get us up towards the 30, 50-day moving averages, right? Above the 200-day again, most likely above the 17-day. But then what does it do there, right? Does it fail and roll back over? In this case, it didn't. We closed right above it there on 816. We retested it later. But as soon as we got up above it with the green tag, we got above it there on 8:15. We were good to go from that point forward, right? Over here, we got above it on 5/6. We were good to go from that point forward. Over here, we got up above it on January 17th, and we were good to go from that day forward. So, we'll get a green tag as we get up to those lines. The issue will be sometimes, like we didn't get a green tag until after we got above the 30-day. It depends upon how small the pullback was. If it's around 5%, you'll get a green tag after you get it back above the 30-day. But if it's a bigger number like it was here and definitely like it is now, then you'll get a 5% green tag before you get there. And that's what, again, makes us susceptible and vulnerable to a correction, right? A failure here and then a move back down below the 200-day and back to lower lows. That's what a correction is. An extended move below the 200-day moving average, not just a move of 5 days. Let's take a look at the VIX and see how the VIX did today. Obviously, we fell down quite a bit. We're still above 20, but we're not above 100% anymore relative to the VIX 3M. And the VVIX is not only not above 110 anymore, but it even closed below 100. So significant change in volatility and sentiment there, which we needed, right? We needed to break the strong bearish sentiment that we had, and it looks like we broke it. So again, just to summarize, like this definitely is day one of stage 2 of a bear market. Now again, a lot of times, as I tweeted out here, we have a lot of instances here where, sorry, I didn't notice the camera had faltered. We have a lot of instances here where we get those red tags. In fact, since the March 2009 low, since the last bear market low point, we've had 34 times, including this one. So 33 others, and then now a 34th red tag, a 34th stage 1 pullback, right? Pullback where we just dropped 5 to 10%, right? It's the stage one. Again, remember, there's the 9 stages of a bear market. Stage one of a like a 5 to 10% drop. So this is the 34th time. Out of all the other 33 times, 6 of them failed in the stage two, right? Stage two, remember, is the pullback bounce. So 6 of them failed in stage two and dropped back below the 200-day moving average and to new lows and moved into correction territory. So 6 out of the 33 prior times have dropped down. So the average decline during the 6 times that failed in their bounce was 11.8%. The average decline for the other 27 who bounced up to new highs without going to stage 2 or stage 3 is 7.34%. Remember, we are at over 10% right now. So you can see the difference here. So I believe the day one for stage 2 just started today, right? For all the reasons we talked about. If I were to go back to 2001 or 2003 to the low point of that bear market, there have been 43 times that we had a stage 1 pullback of 5% or more. 7 of them failed to bounce to new highs and form corrections. 7 of the 43. One of those 7 failed on their correction bounce and went ultimately into a bear market. So in 20 plus years, so since 2003, we're looking at essentially 22 years. In 22 years, the odds of a 5% pullback ultimately turning into a bear market is 1 in 43. So 2.3%, which is the odds of a pullback turning into a correction, which is 16.3%, times the odds of one of those corrections turning into a bear market at 14%. You multiply those two, you get 2.3%. So right now we're in the pullback, and right now there's an 84% chance. It's in the last 20 years, there's an 84% chance we bounce up to new highs, right? No matter what the number is inside, there's an 84% chance that we bounce up to new highs. So that's why I say always expect a pullback. And then whenever it fails, there's still an 86% chance that the bounce off the 200-week moving average will not fail, right? That it will bounce up eventually to new highs. So expect every pullback bounce to get up to new highs. Expect every correction low bounce to get up to new highs every time, because the odds are just so low that they'll fail. And then ultimately, the odds, again, in the last 22 years of one of these, of a pullback like we just had, turning into a bear, ultimately into a bear market after months, right? Because remember, the process takes months. Now, remember, it's a 9-stage process. We won't get a bear market in 6 weeks. It takes months. The odds of what we just experienced turning us into a bear market is 2.3%. I'm going to spend some time going back even further to like the 81, 82 bear market and so on. Now, once we get to the 70s, we had multiple bear markets in actually a short amount of time, starting at the 69, 70 bear market, the 73, 74 bear market, the 78, 79 kind of mini bear market, and then the 81, 82 bear market. Right, so that in a short amount of time, we had a lot of bear markets that brought the CAPE ratio all the way down to single digits. So so that's going to increase the odds a little bit. But I'm going to venture to guess if I go back, another 20 years to the 81, 82 low, and how many we had it going, the odds are going to be, just very, very low that the pullback bounce will fail, or that the correction bounce will fail, and that will ultimately get the bear market there. All right, now let's talk about what's driving this price action. Again, over the last 3 months, the most oversold asset classes bounced the most. That's what you would expect, right? So if I were to go all the way back to February the 20th, when this whole thing started to the downside, again, bond stocks, U.S. stocks especially, like developed market stocks, are not down over the past few weeks. Like U.S. stocks are down 10%, and developed market stocks are actually up 2.5%. Emerging market stocks are flat. So really, it's a U.S. stock story and nothing really more than that right now. Commodities are hit pretty hard, despite the strong weakness in the dollar, which has really helped lift gold up lately. And of course, yields have been down too, with the long-term bonds up. So yields down, the dollar's down, commodities down. That's your three-headed monster for risk appetite, right? Usually it's the other way. Those three are up when those three are higher, that's what puts pressure on equities. But right now, the dollar's down, yields are down, commodities are down, and U.S. stocks are getting hammered. So you can see the relationship has now switched, right? Where we are in that inflationary environment where rising yields, rising dollar, rising commodity prices put pressure on equities, and the vice versa, right? Equities rose when all three of those fell. Now we're in this deflationary environment where all three of those things are down: commodities, the dollar, yields, and equities are really getting, especially against international equities, just getting absolutely hammered here. Now let's just zoom in here on this week that we had. So right here, we'll start off with the March the 10th. And you'll see here that, again, we started off pretty weak, even going into Thursday's close, down about 4.5%, 5% on equities. Q's getting hammered most, but IWM's down there too. International equities are down, but they're up against U.S. stocks, and gold was up quite a bit, 2.5%. Well, gold held its value there, even though the dollar has been flat pretty much all week. Yields have also been flat all week. They're both as flat as a pancake for the week. But equities, which again were the most oversold asset class, they all rebounded. And that makes sense, right? Again, we've been down 10%. They're going to bounce up, and so it was a down week for equities. It's not going to be a down week this upcoming week for equities. We're going to get that green tag before March expiration. I expect that we will. We're already almost halfway there. It's not going to take long. I mean, we might have it by midweek. I still think, early either Monday or Tuesday, we're going to have a down day mixed in there. But we're going to get to that green tag definitely by Friday, if not earlier in the week. And like I said, we're well on our way with today's move. And the question will be, by the end of the week, are we going to get to that 30-day moving average here? Right, that's a big move higher. Well, I guess we're not, right? We might get above the 17 just barely, because that will get us a 5% move. But I don't think we're going to get all the way up to the 30-day moving average by the end of the week. So that rally might actually continue into the post-expiration, into that following week. Remember, there's going to be some down days mixed in there, but we're going to rally pretty quickly and get up there, and then we'll know whether we go into stage 3, right? Stage 3, remember, is a failure at these lines. It doesn't have to be right at them. I'll be a little bit below them, might be a little bit above them. But if we get above them and can't stay above them, then we know we're failing. But a failure at these lines, and then now we're in stage 3 where we move back down below the 200 again, and then to new lows, and then now we're in correction territory at that point. Now we're in stage 3 again. 16% odds of that happening. So it's very, very low odds of that happening. It's much higher odds we bounce up to new highs, but the odds are bigger because of how big the decline has been, as well as all the other indicators I've been talking to you about here earlier in this week. You saw the move in the asset classes. If you take a look at how the sectors performed, again, you can see if I were to zoom out to when this whole thing started, February the 20th, you can see XLK, XLY were the biggest losers. In fact, the only two sectors that are underperforming the market, right? Everything else is outperforming the market. Safety sectors, all 4 of them, all outperforming, are all down, but considerably outperforming the markets there since February the 20th. Again, zooming into this week, and you can see here that, again, going into Friday, energy was up there with utilities, and the safety trades weren't doing so hot, right? Healthcare is not doing so hot. Staples, both down quite a bit along with everything else. But still, you had technology, discretionary, communication services, the only sectors underperforming the market for the week, and then we rebounded in a big way. Technology now is matching the market. You still have some underperformance there. Staples still is now lagging, healthcare lagging, some other sectors lagging. You still have some huge gains in utilities and energy. Again, these are not sectors, utilities and energy are not necessarily sectors that we want to lead the markets. If I were to take a look at their ratio charts here, give me a second to load these up. All right, so we'll come here. There we go. So if I were to take a look at here, let's go to this one. And let's take a look at, well, energy first. Look at that big move in energy. Nice, good move. It's above its moving average. It's rising. It's in the leading category, right, on the daily chart. If I take a look at it relative to its peers, so we'll come down here and we'll take a look at XLE relative to SPY. Again, it's a sector relationship that's typically negatively correlated. So if XLE is outperforming SPY, that usually means SPY is going down. And you can see, look at the big break now for the first time in almost a year above the 200-day moving average in the ratio. Well above the 50, everything's kind of rising, pretty bullish here coming off of lows. So it looks like we're shifting towards energy. If I did the same thing for utilities, right, again, utilities is, when utilities is outperforming SPY, it usually means SPY is dropping. Well, look at that. We are breaking up above. Here, let me zoom out so we can see some context here. We are above the 200-day moving average. We've kind of rolled up here in 2024. We're on the leg higher right now. RSI is bullish. MACD is bullish. The PPO is turning, long-term PPO is turning positive. So the 50-day is about to cross above the 200-day. That's a pretty significant move. Here it is on the regular chart. The absolute basis, again, crossing above its 17-day moving average there. Big breakout, but again, we're above the moving, the ratio is above its moving average. It's in leading category. We don't want that to be the case, right? So that's that's not necessarily the greatest sign to see those particular sectors beating. I mean, not just beating on for the week, but if I were to take a look at the day, I mean, energy, technology also did well, but energy's up there, right? And all these other sectors, discretionary did well, but so is utilities and real estates are both up there. And it's like, that's not, I mean, it's one thing to have staples down. We usually want to see real estate and utilities down here too, and that wasn't the case. So, and we don't want energy up here with technology. We want discretionary up there with technology. We don't want financials up there with them. We want communication services up there with them, because again, financials is also looking pretty good from a relative strength standpoint. Above, moving up almost with 8-day moving average, but look at the ratio doing as well as it is. And if you take a look at this one's not as bearish now. The correlation is not as bearish now. Had a run up to the upside where they were kind of both moving together, but now it's moving back to where it is predominantly in negative levels. And this is a clear bullish trend. In fact, when you look at the relative rotation graph, I mean, they are clearly moving up on a weekly basis, and the other sectors, XLY especially, but even XOK, are moving in the wrong direction. So again, it's a great day. We'll see how things move this week in terms of what outperforms. We really want to have a good week, and we really want to have technology, discretionary, communication services leading the way higher this week. All right, for our trade idea of the day, I want to take a look at Autodesk. Autodesk kind of fits the same description as the market right now. It looks like it's been in this intermediate decline, but this is the first time you can see that the near-term line is crossed, not only 40, but also 50 at the same time. The momentum line jumping up into the upper reversal zone. So while we've been strongly bearish on this intermediate decline and 15% below the moving average, we had our first really good update today. And so we can try to take advantage of what can be a pretty decent move up to a green tag, right? If you look at on this chart, similar to the S&P, the S&P was down 10%. Autodesk was down 20%, and now it's already up 3%, right? So there's going to be a green tag at some point. What number is in it will probably be relatively larger than the S&Ps because, again, the drop was larger than a 20% decline. So you'll probably end up with, some kind of double-digit number there, and we want to try to take advantage of that. If you take a look at, some of these other charts, like the weekly chart, you can see obviously we've been strongly bearish, extremely bearish on the size of the candle. How much more bearish we'll go? Again, this is about as far as we went in April. We ended up with some bearish Hakunashi candles, but you can see the lows never really got lower, and we started to turn up higher again. If you take a look at the 3 green arrow chart, obviously we've been strongly bearish here. We have 3 red arrows. MACD and stochastics, but you can see that MACD is turning up, is almost up, probably will cross above 0. The histogram will cross above 0 on Monday, which means that the MACD itself when you look at the MACD line, which is the blue line on this chart, we'll probably cross above its moving average on Monday because of the again, barring a big drop on Monday. But if it continues this build off of this, point of control, well, not really the point of control, but pretty decent volume node here, about as big as the point of control. We move up towards a 200-day moving average. Remember, we don't have to go up past these moving averages. We're just going to try to take advantage of this, whatever kind of pop we're going to get, if, obviously, if we get a pop. If you take a look at the DMI, you can see all these indicators are extreme, and they're now coming, off of extreme levels. We're breaking below the ADX on the negative indicator, jumping back above 10 on the positive indicator. The RSI and the CCI are jumping up from extremely bearish levels, up above 30 and up above minus 100 there. If you take a look at the Ichimoku cloud, they're at strong bearish levels, but again, well below the rate of change is strongly bearish, well below the cloud. In fact, if you take a look at that rate of change, this is what it looks like here: 18%, almost 20% in 26 days. Again, about as strong a rate of change as we get, over such a short amount of time. And then finally, if you look at the Bollinger Bands and the Keltner channel, what we want to do is, when we're trading like that below the lower Keltner channel, like we have been for so long, we want to get back above it. The momentum is strongly bearish. It's turned yellow now, which means it's starting to, turn direction. We're not in the lowest quartile anymore of this extremely wide bandwidth. So things are looking favorable that we might, again, like the S&P itself, be starting day one of that stage 2 where we get that bounce back up. To obviously, Autodesk is a little different scenario because it has been below its 200-day moving average. Where is it here? It has been below its 200-day moving average for a little bit longer. You can see a little bit longer there than the S&P. And if you look at where it is relative to its 200-week moving average, you can see now we're pretty much almost there too. So when you look at its zigzag, and we actually had, come back over here, we actually had our small declines and failed bounces. So this is probably more of a correction type move, especially again considering we're down 20% since the last screen tag. And so you're probably going to get, again, bigger numbers in here when you're coming off of a correction low point than you do when you come off pullback lows. Whether we fail or not remains to be seen, but at least we should be able to take advantage of the move, potentially, of course, the move off of that low point to the upside. So what I decided to do was to buy a long call option, the at the money long call option, the one with the most extrinsic value. We just did one contract with a 50% stop order there. So again, right around here, let's get rid of the. Here we go. So right around $600 of risk, but if it does one standard deviation by expiration, then we're looking at about a $2,000 gain. So very good reward for the risk that we're taking. And again, depending upon where we ultimately get to, right? Again, what we're looking for now is to move back up to moving averages, especially the weekly moving averages, because like I said, we're in kind of correction mode here. So if we were to move back up to 285, then you can see in that range, and that's one standard deviation away for this time frame. That's a really good reward for the small amount of risk that we're taking on this trade. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us on MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Friday night and weekend, everybody, and we'll see you all next time.